Russia. Russia, incidentally, is the chair of Brics and has been driving, sort of monetary policy thought for Brics. China will be the next chair of Brics. So you can see that they've got a very firm hold on the way Brics is developing and how trade settlement is going to occur. So all these factors seem to me to be at the worst possible time for America, when it's just entering a debt trap, driving the dollar out of use internationally, which basically means it will be sold down in the markets. We're already seeing this. I mean, when you look at what the Central Bank of China is doing, I keep on telling people they're not buying gold, they're selling dollars. The emphasis is important to understand. They are selling dollars rather than buying gold. And that's a process which I see continuing.
In the shifting sands of global finance, the role of gold and silver as safe haven assets has seen a resurgence, a trend strongly advocated by economic commentator Alasdair Macleod. Amidst economic uncertainties and geopolitical tensions, these precious metals have historically provided a hedge against currency devaluation and inflation. The recent interest in these metals isn't just a trend among private investors, but a strategic pivot among nations, particularly those in the Brics bloc: Brazil, Russia, India, China, South Africa. As these countries diversify away from U.S. dollar dependencies, gold and silver are increasingly featured in their monetary strategies, aligning with Macleod's long-held views on financial stability and sovereignty. Macleod has voiced strong support for the rationale behind this shift, which becomes clearer in the context of current global financial dynamics. The Brics nations are actively exploring alternatives to the dollar-dominated world economy. Their goal is not only to reduce exposure to the dollar's volatility, but also to challenge its hegemony in international trade. By bolstering their reserves with gold, these countries aim to enhance their economic sovereignty while stabilizing their currencies against market shocks, a strategy that Macleod has frequently highlighted in his analyses. This movement towards gold-backed assets is part of a broader strategy that includes the development of a Brics-based payment system that could operate independently of Western financial systems like SWIFT. Macleod sees these developments as a deeper geopolitical shift, where economic tools are wielded to foster greater independence from traditional power structures. Gold and silver, with their inherent value and historical role as monetary foundations, are central to this strategy, reflecting Macleod's advocacy for their role in modern monetary frameworks. Now we'll show you the best clips of the latest interview, but first, smash the subscribe button and turn on notifications so you do not miss out our daily recaps. Enjoy the episode.
Russians who do understand the benefits of putting the currency on a gold standard. I mean, I'll give you an example as to why it really would be very, very good for Russia. At the moment, the central bank's deposit rate is 16%, and that's what's needed to stabilize the ruble. If the ruble went on to a gold standard, then practically for Russian banks, for example, Chinese banks, other banks, it would make sense for them to buy gold in the West, where the yield is 2%, sell it to the Central Bank of Russia in return for rubles, which linked to gold is a gold substitute, and they're picking up 14% on the way. What's not to like?
Yeah.
That is actually the way in which you manage a gold standard. You don't use interest rates to try and manage the economy. You use interest rates to manage your gold reserves. And that was learned the hard way in the wake of the 1844 Bank Charter Act in the UK, because it failed something like 3 times before they actually realized that you don't use interest rates to try and manage an economic outcome or to manage the banking system. What you do is use it to exclusively manage your gold reserves, and then you don't have a problem. So on that basis, it's very easy for Russia to stabilize her situation. And just think of the benefits. Interest rates would then decline. Russians in business would find that they can, if you like, their business calculations become a lot more profitable. It means that they will be able to cut the cost of their output and all the rest of it. It would be like another industrial revolution. I mean, it would be fantastic for Russia. And it would actually get her away from having to rely on the export of commodities in order to have a surplus on A, her balance of trade, and B, on her budget. The situation in Russia is that taxes, if you look at personal income tax, it's around about 13%. The higher rate is 15%. I mean, these are levels we dream of. Corporation tax is 25%, admittedly. The government debt to GDP is, and this is despite the war and all the financing of the battles against Ukraine, debt to GDP is only 21 or 22%. So you can see that actually Russia is in an amazing situation, and she can easily go onto a gold standard. And she has been pushing for this. She wanted to get gold, a gold-backed currency onto the agenda at the last Brics meeting, but it was turned down by China and India. India does not want to upset the West. India is not in a position, really, to consider a gold standard because she's been in denial about gold for God knows how long. She's tried to stop her citizens from buying it. It's only recently that she started increasing her gold reserves once she realized the geopolitical situation she was in. As far as China is concerned, it's clear that China does not want to rock the boat. China does not want to poke the American eagle, as it were, by overtly being responsible or partly responsible for the collapse of the dollar. So while China has made contingency plans against that event, she's going to await developments, I think, before she takes a move to protect her own currency. And when she does, it's almost certain that she will also put her currency onto a gold standard. The happy band of brothers, if you like, going into that lot. I mean, you've got Saudis who, I understand, the 50-year agreement to accept only dollars in payment for oil, that's now come to an end as of this week. So, the petrodollar, the petro yuan is really going to start building. I see that continuing. In spite of Iran's terrible currency, I think the Iranians would be quite keen to stabilize her position with gold. And this is true of many other countries within the Shanghai Cooperation and Brics ambit. It's fascinating because the problem that countries like Brazil have is that the valuation of her currency is not so much dependent on things like money supply and all this sort of stuff and the government finances, though obviously it comes into it, but it's just purely the markets look down on these emerging market currencies, and as far as they're concerned, as far as the markets are concerned, they're trash, whether they are trash or not. So there is absolutely no benefit to a major economy like Brazil's of having a fiat currency. They would be far better crystallizing the value of their currency and putting it on an international standard, which is effectively what gold does.
The silver market is experiencing a deficit for the third consecutive year. Michael Steinmann, CEO of the mining group Pan American Silver, talks about the robust growth in demand for the precious metal, declining global inventories, as well as the company's opportunities and challenges when it comes to new mining projects. Precious metals are attracting increasing interest. After a long sideways trend, gold and silver have come to life. Meanwhile, consolidation among mine operators is progressing. For CEO Michael Steinmann, it is evident that silver will play an increasingly important role in the modern economy, especially regarding the energy transition to renewables. However, while demand is increasing, supply capacities will remain limited for the foreseeable future. There will soon be very little inventory left, says the Swiss mining executive with more than 25 years of experience in the sector. Consequently, any uptick in investment demand coupled with ongoing industrial usage could create a particularly bullish scenario. It's important to point out that silver has two primary drivers: industrial demand and investment demand. Last year, investment interest softened quite a bit, similar to gold, where you could observe consistent outflows from gold ETFs. Yet the price of gold held up relatively well, and this strength can likely be attributed to significant gold buying by central banks. Strong and growing industrial demand, coupled with a resurgence of investment interest, has driven the price up to around $30 per ounce. Obviously, if the Fed keeps interest rates higher for longer, this will have a negative impact on gold and silver or any commodity, since higher interest rates typically lead to a strong dollar. Nevertheless, we see very robust prices. And by the way, not only regarding gold and silver, but also in the case of base metals. How are you currently experiencing investor interest in silver? We're in a good spot right now, but there's still subdued investment demand. Don't forget, we're only sitting at around $30 per ounce here, while gold and copper are basically at all-time highs. Historically, silver has seen peaks above $50, so we're still some way from that. Now we'll show you the best clips of the latest interview, but first, hit the like button, smash the subscribe button, and turn on notifications so you do not miss out our daily recaps. Enjoy the episode.
What it does is it undermines the use value of the dollar, not for US domestic purposes, but internationally. And we should bear in mind that according to the US Treasury tick figures, foreigners own, in total, roughly $32 trillion and dollar-denominated financial assets. So they won't need to hold on to that quantity of dollars. So you can see that there will be selling of dollars. Now, the problem for the sellers is, what do they buy instead? Do they go and buy another currency? Well, I've just sort of enumerated the problems of the other central banks in the major currencies. The answer to that is no. So, if they come out of the dollar, they either go into something like the Chinese yuan, or they go into gold. I think this is one reason why central banks, who have seen this coming, have been increasing their gold reserves substantially for the last 2.5 years. And that is a process which will continue. And the fascinating thing about this is, let's look at Singapore. I mean, it's rather like a canary in the coal mine. Singapore has bought enormous quantities of gold for such a small island. I mean, I can't remember. I think the population is something like 9 million or something, which is not vast. But, she's got substantial gold reserves now. Now, why is she doing this? She's doing this because Singapore is run by a Chinese diaspora. They know what's going on in China. They understand the mindset. They understand the politics of China and the whole of Asia. They can see the Shanghai Cooperation Organization business for what it is, and they know that they're in a wonderful position to really benefit from this. So what are they doing? They're setting up effectively. Not only are they setting up to protect their own currency from the demise of the dollar, which inevitably will follow, and of course all the other dependent currencies, but also they will probably become the non-Chinese regional center for gold trading. I think they plan to go in that direction. And there's a guy who I got to know quite well, Shakoe Fan, who is the World Gold Council East Asian and central bank representative. And, he came out with a paper just the other day saying that, Singapore is going to be the vaulting center for central banks in the region. And I think that's a very interesting point he makes. I would agree. Is that this is really looking very much like a repeat of the 1970s, rather than the period of the last few decades when we have seen interest rates go low, be suppressed low, without any apparent consequences. The 70s were very important because that gave rise to stagflation. a term incidentally invented by my uncle when he was opposition. He was the shadow chancellor in 1960s, late 60s. So, inflation is not going away. And so, therefore, lower interest rates are not going to stay, they're not going back to low interest rates. I mean, may get a cut or so, but I mean, the reality is that interest rates will rise over the rest of this decade, and they could rise a lot more quickly than they did in the 1970s. And there is a further problem, again, looking from 60,000 feet, and that is the level of indebtedness of governments, and particularly the US government, with a debt to GDP running at, 130% or thereabouts. The problem I think they have is that the foreigners are no longer buying dollars, and they are the people who will price government debt, US treasuries, at the margin. And if they're not playing ball, then these yields are going to rise. And the more they rise, the more the US government is in a debt trap from which it just cannot escape. Well, it can if it was prepared to take the political decisions to cut spending to the degree where there was a surplus on the balance of payments, on the budget balance. And that would also, incidentally, go a long way to correcting the balance of trade. Now, under those circumstances, there could be some recovery in the dollar, but there's no way that's going to happen. I think we can agree on that at the outset.
What do you think of Alasdair take? Do you think he's right on today's show? Post in the comments section your honest opinion. Share this video with a silver bug and check this episode right here because it's a perfect fit for you. I see you on the other side.